So, first of all, do you just want to kind of give yourself a short little introduction, tell everyone about what you do?
Yeah, sure. So, hi everyone. My name's Sam Salloway. I am a managing director and I head up the real estate private equity division within Trez Capital. I'm based here in Toronto. As you can probably tell by my accent, I'm not from around North America, but I'm English and I moved to Canada pretty much 2 years ago now.
Sweet. So you're saying you're the head of equity at Trez. So what exactly does your role entail there, and how did you get into that line of work in real estate specifically?
So I guess the way I got into real estate really was through I guess like during school doing work experience and those things kind of discovered real estate. Was lucky that I guess I had some family members in the brokerage world and did some work experience with developers and other investors and kind of really got an interest for the investment space within real estate. And so I ended up getting onto one of the graduate programs at one of the large real estate firms in London. And that kind of then, rolled up into me landing a role at Brookfield Asset Management, which actually is a Canadian firm. And really, that was a great place to cut your teeth in terms of, getting exposure to large deal flow and also, operating businesses as well as the real estate. So, some things we were working on were, hotels where we would actually own not only just the hotel buildings, but actually the operating company that operated within them. So that was a great place to live and to learn and to, as I said, kind of, cut your teeth and to kind of hone your skill set. And then in 2021, I moved to Canada, to Trez, and so really what we do is on the equity side at Trez is we make investments in real estate development projects, and other I guess value add projects. And when I say value add, that's where we'll buy unloved or let's say old and dilapidated buildings, or something whereby we can create value by increasing rents, improving the offering in terms of its flexibility to occupiers and therefore its value. So that's kind of, I guess, a broad brush response, I guess, in terms of how and what I do today.
Yeah, that's awesome. So, but you mentioned that you had some family connections in the business, but more on the brokerage side, that you chose to go on more into the equity side. Is there a specific reasoning behind choosing equity? And when you got into the business, and for anyone looking to get more into the investment development equity side of real estate, what are some skills that you think are super valuable to have as you start applying and looking at internships?
Yeah, it's a really good point. So I think, within real estate, you've got essentially two paths you can take. You can go down the brokerage route, which is where essentially you are an intermediary between buyers and sellers. And that can be highly lucrative because obviously you'll get paid a commission, a percentage of what the percentage of the deal is. And so in good times, you could make, multi-millions by being a broker, and doing brokerage within real estate. And the skills you need for that are really, being super personable, being able to, actually go and actually negotiate and broker deals, being able to find out, okay, well, this person is looking for this, and this person, is selling that, and being able to really, I guess, find a needle in the haystack and being a bit more of a hustler in that regard. And so that's the brokerage side, and then on the, let's say, the principal investing side, and as an investor, it's more, okay, well, you're dealing with brokers who are bringing you deals, but you're now looking on a much more analytical point of view. Okay, so what are the risks associated with this? How much money could we make if we did this, this, and this? What are the chances of that happening? And it's a lot more of telling a story and building a business plan around a specific thesis, and then acting as an investor that way. And so much more, dialed into market and economic, drivers, and whether it's interest rates, whether it's the way in which other asset classes are performing, how much, rents are either going up or down in certain markets. So all of those different factors will go into your thought process as an investor. And so there's much more analytical and business minded, whereas brokerage is still analytical and brokerage, and business minded, but it's a lot more about, really trying to, create transaction volume, do deals and a lot more of that. It's probably a lot more fast paced than being a principal investor on the investment side.
So I know you had an intern on your team this past summer. And what was something when you were looking to hire somebody for that role that just stuck out to you? Like, this is a skill that I really appreciated, or something in the interview or application that they did or said that stood out? It's like, this is somebody I would like to work with and I see adding value.
So the number one thing in real estate, and it goes back to actually the brokerage point I was talking about, it's people skills. I really think, more so than any other industry is people skills. And if you work in, finance, you can sit behind a desk and you can trade and not communicate with anybody all day. Whereas within real estate, you need to speak to people, you need to be on the road, you need to, there are dinners, there's social elements towards real estate where, that's how we, there's a lot that is essentially baked into a day in the life of someone working in real estate. So I think having, good people skills is definitely something that is, something I would, encourage. If you have that, then this is a good industry for you. But in terms of, what we would look for as opposed to just the people skills is really a willingness to learn. Because, I think for anybody starting their career in real estate and coming into, whether it's a brokerage house or an investment company, you're not expected to be the finished product. And, we're not expecting you to have all the right answers to be completely perfect by day one, but having the right mentality and willingness to learn is absolutely the most critical thing, because, that willingness to learn and be honest and to be accountable in that sense is really valuable for any employer, for any team, and particularly in this industry, because the more you learn, the more effective you can become over time.
Absolutely. So I wanted to talk a little bit about your role at Trez. Like, obviously you were working in the UK for Brookfield Asset Management, and now you've come over to Trez in Toronto and you're running the equity department there, which isn't just the Trez opportunity funds and the Trez open-ended funds. But why did you make that jump? Was it the specific opportunity that interested you, or was it something that was always on your mind and this was just the right move at that time?
So, Trez is, for 25 years has been a debt investor and has been providing construction financing to developers in both Canada and the US. When I was moving to Canada, and personal reasons were, my Canadian wife was actually pregnant, wanted to move back to Canada. So I was essentially speaking to a bunch of Canadian firms, of which obviously Brookfield was one of them. But, Trez was officially launching its equity platform to really have a dedicated resource to invest as owners, as the equity behind a project versus being the debts. And that means if the project does very well, then the equity gets paid off very well. If it does very poorly, then also the equity does poorly. But the idea is that Trez was launching essentially a blank canvas of a new platform to grow the equity business within both the US and Canada. So for me, it was an amazing opportunity to bring the skills I'd learned at other places. Yes, okay, they were within Europe, but I guess the skill set applies to whether you're in Europe or if you're in North America. The market is the only thing that you need to learn. The skill sets are otherwise the same. And so, roll forward 18, 24 months, and we've now got a portfolio with over $2 billion US. And growing. And so, it's been a really active time, and starting a platform from scratch like that has its benefits, because you can really keep it lean and mean, as opposed to the bigger companies that obviously, they're a bit more of a juggernaut of a ship, and the turning circles aren't quite as steep as a speedboat, to use that analogy.
Yeah. So I guess a couple follow-up questions to that. The first one being, obviously it's a great opportunity to be able to start something from scratch. I know that's how I've felt with this club here at the university, but where do you see yourself going from here, having obviously got this from zero now to $2 billion. I'm assuming that's the asset value upon completion, that $2 billion number. Yeah. So that's a huge jump in less than 2 years from the creation of the fund. So do you see yourself working long term to improve this fund and work on other projects? Or is there certain roles you have in mind as you get further into your career that are of interest that feel to be on the same linear career path?
Yeah. Well, I guess I joined Trez, with the idea that obviously, this was going to be, it's starting from a blank canvas. So, ultimately the options really are endless, but, really the focus to date has been in residential within mainly the Sunbelt states within the US. So within, Texas, Arizona, and Florida. But there is so much more that we could take. First of all, residential in itself is a hugely growing sector and will continue. People always need a roof over their heads, and so developing high quality new residential real estate will always have its place in the economy. But for us, there's expansion within industrial with the growth of e-commerce. The hotel sector is hugely picking up after COVID and people wanting to travel again. There is really interesting options in super cheap office real estate and actually whether that can be converted to residential. And there's also things like retail and other plazas where you can develop mixed use both retail and residential as well, where the two will blend very well together. And then there's also risk strategies as well. So, right now, TPREF, our main fund, which is the $2 billion fund I mentioned, that is building assets and then holding them for the long term. Now, what we could do is we could have a slightly more of an income generating fund where we could buy assets already built. They have tenants and occupiers already paying rent, and we'll buy that, and then we can essentially just pay that rental income to our investors over the long term. So more of an income vehicle. We could do shorter term development funds where larger development funds where we're purely doing the development play. We take a raw piece of land, we'll build it, lease it, and then sell that on to another investor, and and then move on to do that again. So there's opportunities in sectors, there's opportunities in risk as well. But for us, my ambition is to take this platform to to be one of the best North American real estate equity shops out there. And we're on a great path right now, and we need to build the right team and make the right investments, and we'll get there.
Absolutely. So obviously, having worked a little bit with you this summer, there is a big difference between purchasing a project that's already completed and then using it for income, like you said, as opposed to developing it from the ground up. Now, for those who aren't aware, what would you say is the benefit of each strategy and the difference in cost between the two as well?
So typically, a property that has been built and is what we call stabilized, meaning that essentially it's at its stable value because it has it's fully leased with tenants and of some kind, whether it's commercial or residential. So at that point, when you imagine a shiny new residential building that has tenants in there, that stabilized asset is at its peak value. So if you compare that to the cost that it would actually build that building, typically you'll see about a 25% difference. So meaning it is so based on your development cost, you can make a 25% profit margin between what it costs you to build it to what it's worth valued at once the time it's stabilized. So what it means as a benefit for investors in development is that we are investing at that cost basis. So we're not having to pay the premium for the future value that it will be worth. So if you build it and hold it at, let's say, $100, but it's worth $125, you can essentially, you're holding an asset worth $125 for the long term, but it only costs you $100. On the flip side, somebody who wants to, go and buy an asset that is income producing, they would have to pay the $25, the extra premium, whereas us as development built to holders, as it were, we don't have to pay that premium. So all that means is that the rental income based on your cost of 100 is better than your rental income based on a purchase price of 125. So that income profile differs for development players as well. So it's both a profit margin gain and an additional what we call yield on cost. So the difference between essentially our cost and the yield that we were receiving on rental income.
So it seems like there's a pretty decent risk premium you guys are getting for being on that development side rather than purchasing an existing asset.
Right. Yeah. So just to give an example, we typically underwrite to 100 basis points spread between market cap rates, i.e. what someone would pay, versus the income to us as the development, developer, I should say. So, we're being paid that additional income, by taking that risk.
Mm-hmm.
Yeah.
So this is a bit of a two-parter. You mentioned earlier that you've seen an increased deal flow, which might go contrary to most people's expectations, given the market and interest rates right now. And we do have a lot of people that are interested in personal investment in real estate. So I guess the first, when you're factoring in increased deal flow, is that because people are looking to the future when these projects will be completed 2, 3, 4 years from now, looking at the market expectations then? And with personal real estate, would you expect those conditions to change anytime soon, or would it again be looking at something 2, 3, 4 years from now?
Well, I guess no one has a crystal ball. No one has a crystal ball, but one of the reasons why we're seeing more deal flow and why we're engaging in more deal flow is to your first point, and essentially that is, if you start a development project today, let's say mid 2023, it usually takes you 2 years to build and then another year to lease and fully stabilize. So if you started in mid 23, you're going to be delivering a stabilized asset in mid 2026. And I think all of us could agree that the market's going to be in a better place then than it probably is now. And so those investors that are making those bold decisions in today's market, and obviously with conservative underwriting around it, I think they're going to be the outliers. They're going to be the outperformers when it comes to looking at the future performance on funds and how they invested today. How does that impact people personally? I think it's different. It depends if you're doing development yourself personally. I guess the same principle applies. But in terms of how the market is looking, I mean, I saw one of the stats this morning. I mean, Canadian real estate sales are back to super low transaction volumes, and that is obviously because there's a lot of confidence that's been whacked out of the market. But at the same time, immigration in Canada is the highest that it's ever been, and I'm sure that there's going to come a point whereby confidence is going to come back, and all of a sudden those people that that have been sitting on the sidelines for so long are going to pile back into the market, and we're going to see some growth again. How long that's going to take, I don't know, but I do think that's what's going to happen.
Yeah, for sure. It's good to know that there is some future outlook coming in there, because I think most people get so focused with development on right now as if those projects will instantly spring from the ground. Kind of a little bit of a follow-up question to that about TPREF and the opportunities that you guys see there. You mentioned the Sunbelt states earlier, and then you briefly talked about the jump in demand in Canada. Do you guys do any equity investments through TPREF in Canada?
We haven't looked at it, but essentially the way in which Canada works, and funny enough, I had a meeting with a developer, a Toronto residential developer this morning, and we were having this exact conversation, and the challenge in Toronto is really that condos pencil out from a financial perspective much better than purpose-built rental. Rents have really got to come on such a long way for deals to work that way, and also for condo builders here in Canada, as you probably know, a lot of them are pre-selling homes actually before they're even actually constructed. And so what that means is that the numbers can work so much better if you pre-sell homes than if you're going to try and take the risk to build them and then rent them out at the back end. So yes, we've looked at deals, but given the pure, I guess, quantity of homes and also, I guess, some of the financing structures and, how much leverage is available down in the US, we've found more opportunity down in the US, so far. Places like Austin have been growing enormously. Phoenix, the Florida market, all of these places, have been really seeing huge amounts of both, immigration and in-migration. And so, I think, we'll continue to look at Canada. I'd love to better do something in our, our own backyard, but right now the returns have been more attractive in the US and in the Sun Belt than they have been in Canada for now.
So one thing we've been chatting with a couple developers over the last few months, and a theme that comes up a lot for us is the zoning policies and practices in Canada, specifically in our city in Victoria here. We heard one story of it taking 5 years for a piece of land to be rezoned for multifamily construction. And obviously that would add a lot of front end costs and risk to an investment here. So would you say that's a consideration when choosing to invest in the States, where those rezoning and zoning policies and laws are a bit more lax and fast acting?
For sure. I think Canada is definitely, behind when it comes to entitlement and zoning and getting things, shovel ready. So that meaning, we can actually start construction. 5 years is, I hear those stories about 5 years, and frankly, they're the outliers. And it really takes about 3 years. People will, if they're in a salesy mood, will say 2, but really it takes 3 years to get something entitled in Canada. And, I guess, that is for the right reasons from the local municipalities. But at the same time, I think, there is too much red tape to actually, to allow new development to take place. And what that's meaning is it's just making it more expensive to renters and to owners to actually buy new homes because there's not enough supply coming online. So it's helping developers that are getting the entitlements because there's such few new supply coming into the system. But yeah, you're right. I mean, I guess a Texan multifamily developer would be pissed off if he didn't get his entitlement through in 6 months, just to give you a comparison for, the timeline to actually get something ready to develop. So it's definitely a challenge for Canada, but, I think they are working on it slowly. So 3 years is typically how long it takes though.
So still a decent chunk of time, and especially when a fund like TPREF
and it's carrying costs. You're right. Right. Those carrying costs can be hugely impactful, especially when you want your capital to get to work as quickly as you can. Some developers with deeper balance sheets and pockets can they can afford to carry the land for a bit longer, and then obviously there's sometimes a lot of developers here. Kingset Capital as an example will take assets through the entitlement process, get it fully zoned and entitled, and then trade out to a developer that wants to buy fully entitled land. So you see a lot of that in Canada, whereas in the US you will see developers just take land through from unentitled all the way through to construction. It just doesn't take as long.
Absolutely. Yeah, it's definitely something that we've been hearing needs some work, and 3 years is definitely a huge period of time. Think about how fast, how much the market's changed in the last 3 years since 2020. It caught fire and then got coated in fire extinguisher, and all in the span of 3 years. So I guess potentially one of my last questions here, what do you spend most of your time doing with the fund? Are you more working on a high level thing? Are you sourcing deals? If you are the one sourcing deals, how do you go about doing that?
So sourcing deals comes from multiple channels. One is obviously you need to be there on the ground, whether if it's in the Sunbelt states or if it's in Toronto, wherever you're trying to do deals. It's being at events. It's being forcing your way through to introductions, whether it's through lawyers, accountants, through lenders, and other developers and those things. So I guess, being out there and talking to the market, you will get referrals and find deals that way. Track record and obviously having a name in it for itself, will generate new leads. We've been doing a lot of thought leadership in the Canadian real estate press recently that's been generating new leads, and then obviously there's the brokerage channel, and that's probably one of the biggest ways to to originate and to find new deals is that you have brokers both in Canada and the US that will essentially work with a developer and try and find a capital partner for that particular development project. So that's, I guess, that's some of the ways, and then obviously through relationships, whether it's with certain landowners, whether it's with other I guess people within the financial industry that will know of opportunities and refer you that way. So there's no, I guess, black and white defined way to originate. It's about, having to make sure that you're connected and dialed into the market. And then, then it becomes easier. Once someone sees that you did one deal, then someone will call you up and said, "Hey, I saw you sold this, or you bought this, or you're doing that," and then they'll say, "We've got something similar." So it's about being active in the market.
Absolutely.
And then in answer to your, sorry, go on.
Well, finish your answer first.
No, I was just going to say, yeah, in terms of day to day, yes, obviously a lot of origination is happening right now, but also given what's happened to the market, we're spending a lot of time looking at the portfolio. How are things, how are costs looking? What is the current market like for takeout financing when we stabilize? Are we renting at the rates that we expected? All of those things that we're making sure that the assets that we've acquired or that we're working on are performing as expected.
Awesome. That's my official last question, as we just run up against the time limit here. Is as a student yourself, was there anything that you were doing to gear yourself up? Any courses, programs you were taking to do so, to get into this industry? And is there anything you would be recommending to current students now in terms of programs, certifications, interests that they should be taking up as they look to get into the real estate industry, either personally or as a career themselves?
So yeah, I think skill set wise, obviously, I think having a good financial toolbox that is obviously very, very important, especially if you want to be more on the principal investing side. Being able to financially analyze deals and to run different financial models, that will be required at analyst level jobs, so that when you're actually submitting yourself a job offer for new job offerings and those things, you'll need to do a modeling test. So that modeling side of things is important. There's courses out there, so many, both on modeling, but also just general introductions to real estate that, I think, it's a Wall Street or Oasis and all those things. But I think I can probably follow up with some examples from, some real proper examples of courses. But really, focusing on network again, I think the people side of real estate is so important. Obviously your kind of colleagues and the friends at university are one thing, but then the city that you want to work in, and actually it's the people outside of university friends is where perhaps actually be able to call on favors and where you'll really generate business going forwards. And that would impress employers, when you can actually show that you've gone out of your way and taken the initiative to go and speak to a lender, even though you're an investor, or go and speak to a broker, or go and speak to a lawyer, a real estate lawyer to pick their brains. Those things are the most valuable and probably the best advice I'd give to anyone at the start of their career.
Awesome. Well, I think I've got to let you go here while you get off to your proper media training, but I appreciate you taking the time to sit down with me, and I'd love it if you could follow up with those links to some modeling courses, as I know it's definitely a huge part of what you do in an internship role in the equity sector of really any financial type of business. So it's definitely a valuable resource to have access to.
Yeah, no, for sure.
Again.
Well, it was great.
Yeah, well, I
great chatting to you.
Down, and hopefully we can chat again soon, maybe in a less formal setting.
Sounds good. All right. Enjoy your afternoon.
Okay.
Okay. Cheers, Simon. Thanks, everyone.